you can look at this in a different way. You can look at this like an insurance company. Insurance companies will take a look at your house, and if your house is, let's say your house is worth $200,000, the insurance company will say, okay, to insure your house, we will come out, and if it burns down or whatever, we'll pay for it, whatever. And the premium that you'll have to pay on an annual basis is $450. And you say, that's not a bad deal, actually. I pay $450. If my house burns down, they pay me $200,000 for the house. That's not a bad deal. Well, guess who makes more money? The insurance company or you? The insurance company, obviously. Well, the insurance company makes money because they write policies. It's just like writing an option. They know that the probabilities are in their favor when they write that contract with you. They collect the $450 premium to insure your house. Well, guess what? They do it over thousands, hundreds of thousands of properties. And they know exactly what the probabilities are that one of those houses is going to burn down. The fact is that it's extremely low. The probability that your house is going to burn down is extremely low. And we go back to this trade tab for a second, you can see the analogy. It's just like this. Let's say you buy the $60 strike price for 8 cents. Well, the probability is that it's ever going to be worth any money by the third week of May when this option expires is only 3%. When an insurance company insures your property, what do they do before they insure it? Usually they send someone out to take a look at it. Maybe they'll take a look at, they'll come on the property, they'll take a walk around. Very few of them even go into the properties. They just kind of drive by, maybe take a picture, and that's it. If the property looks like it's fairly well kept, then they're going to insure your property. And they know they're going to collect that $450 premium. And they know that the probabilities of your house burning down because you've been able to keep it up is extremely low. And they're going to keep that $450 premium. You don't get that back, right? So they keep $450 premiums on thousands or hundreds of thousands of properties. And that's how they make their money. They just collect the premiums. Well, that's what we're doing in the market. We're basically we're selling these contracts that have extremely low probabilities of ever being worth anything. And as these options continue to erode over time to the point where they are worth almost nothing by expiration, we get to keep the premiums just like the insurance companies keep the premiums on the houses that they're underwriting. But just like an insurance company, though, every once in a while, guess what happens? A house will burn down. Well, because they've collected premiums on so many different properties that they're able to easily pay for that one property that does burn down. Out of 10,000 properties, maybe one burned down. Well, they've collected, $4.5 million in premiums, and they only had to pay out $200,000 once for a house that burned down. Who's making money? Well, the insurance company is. The insurance company is making a lot of money. And that's exactly how you can take a look at this business. We're going to be selling these options, collecting the premium just like an insurance company collects the premium, and then we're going to protect that investment or that premium and writing that contract by buying another option. Because we cannot write thousands and thousands of these contracts, thereby ensuring, just like an insurance company does, we do have to hedge our, but it's basically the same thing that an insurance company does, is that they will actually go out and purchase other contracts and hedge their investments through their own investments and hedge their insurance fund and their insurance premium collections through other investments, so that, if let's say an entire section of a city gets burnt down for some almost extremely low probability event, they still have the money that they need in order to pay the homeowners. So, there are extremely low probability events that do occasionally happen. And that's why we take both sides of the trade. We don't sell just the call options. We sell the calls and the puts. And the reason that we do that is, well, think about this just for a second. Now, an insurance company, they're only taking the premium on one side of the trade. They're going to say, okay, if your house burns down, it's just like writing a put option. If the price of the stock goes down, we'll pay if your house burns down, and if you're the writer of an option on a put option, and the price of the stock goes down, well, you're going to have to pay up on it. But unlike an insurance company, we can take both sides of the trade. We can sell the calls, and we can sell the puts. And guess what? The price can't be in both places at one time, can it? It can only be in one price. So if the price of the stock actually goes up dramatically, and this side of our position gets hurt, well, we've got a profit then. If the stock is going up, that means that our profit position on this side is very, very good. So we made a profit on this side, even if we lost a little money on this side. And if you take a look at the adjustment CD, you'll see exactly how we can even, salvage the more profitable position on the upside and still make a profit on the downside too. It's really an amazing process.